how do you buy stocks during a volatile market? The market over the last year has been crazy. The NASDAQ is down 30-some% since the year to date. S&P is down over 20%. And Jamie Dimon yesterday said that he thinks stocks could go down 20% more. Spoiler alert, I think they'll go down much more than that. And there are other videos I've had where I explain this in full detail. But first off, very simple question. Should you buy stocks on the way down? Mo, what is the very simple response to that question?
Yes.
Yes. Should you buy all stocks on the way down?
No.
No. Which stocks should you buy on the way down?
Companies that start falling into your value and you want a dollar cost average down, or ETFs that you're dollar cost averaging into every single month.
So the big fear that a lot of people will have during a down market is my money going to go to zero? So to Mo's second point, if you buy a long-term ETF that's market-based, like VOO or SPY, in order for those to go to zero, the entire S&P 500 has to go to zero. For the entire S&P 500 to go to zero, what has to happen to the U.S. economy? What has to happen to this world that would happen?
Yeah, I would imagine I don't think I would want to be alive anymore if
that is
S&P
correct.
went to zero.
As I've said in many videos, at that point, it's whoever has the most land and guns will probably win and survive.
And guys, I think something important to point out about that is you need to be able to control your emotions. I've actually heard a lot of people say, I didn't want it to go to zero. I'm like, do you understand what zero means? That means that Apple, Microsoft, Costco, all these companies are gone.
Yep.
Gone.
And guess what? On an individual company basis, I can understand that a little bit more, but it also depends on the company you're looking at.
And when you put all of them together,
oh yeah, that's
like, come on.
That's just gibberish.
Yeah.
So buying stocks on the way down is a great way. Now let's look at some companies here. Let's look at one company. I always bring up Microsoft as an example because Microsoft is a company that boomed, was considered dead, and then all of a sudden revived. So let's go to the max chart for Microsoft. Now, you might not see this as well because of how small it goes. However, I'm going to do this now. I'm going to go to custom chart in our software, and I'm going to edit the date range. 01/01/1999 to 12/31/2018. Okay. Guys, in 2000, the stock hit almost 60 bucks. Along the way, it fell all the way down here. Right here, I think it was like $13 or $14 a share. Now, obviously, this was scary for people. And this made people feel like this is terrible. And I'm obviously cherry picking a certain stock. But do you wish you'd bought this along the way? Absolutely you do.
Yep.
Let's pick another example. Let's just go look at SPY, the S&P 500 ETF. Look at this max chart. As this thing fell and rebounded and fell again, do you wish you'd been buying all along the way? Absolutely. Guys, this world has seen, in the last 22 years, terrorist attacks, ridiculous elections, stolen elections, not by Trump in 2020, by the way.
Okay.
Things like that. We've had
global financial crisis.
Global financial crisis. We've had wars. We've had all these things happen. And guess what? Stocks still went up because the world economy is still growing. The U.S. economy is still growing. Every economy is still growing. Yep. So if you believe in an economy and you own S&P 500 ETF, your job is to always buy month in, month out. Stocks, I always show this example here. What I do is I sit there and show everyone that this is where stock values go over time, but this is how the prices go. Your job is to buy all along the way. You're going to overpay sometimes, you're going to underpay sometimes, but what's going to happen? You're going to buy this. You should look at the exact same way when it comes to individual stocks. However, it's about having that right process on the individual stocks that will make you understand that buying when they fall is important. It is scary when you have stocks fall 30, 40, 50%. But your job at that point is to take a step back and say, okay, let me reevaluate. Let me go look at more of the bear cases, more of the bull cases. Do I believe my thesis is still intact? If your thesis is still intact, you buy more, or at least you keep the shares. Yeah. I don't know how your portfolio is. Are you sticking with a certain percentage? Because I have stocks right now that I bought that are down 40%. And because I already hit my limit that I self-impose on myself, I might not be buying more. But I might be going, man, I really wish I could buy more. That's happened on a few stocks that I have. I go, damn, I wish I could buy more. But the point is, your job as an investor is to look at the opportunity given to you at that one time. And you sit there and say, what I do for myself is this company going to be around for the next 10 years? If the answer is yes, my next question is, do I think it'll be a bigger company in the next 10 years? And third is, if the answer is yes, is do I think the fundamentals of the business in terms of debt and number of shares outstanding is going to change drastically where that bigger company effect will be taken away by more debt or more shares? If the answer is no, then I have to sit there and say, okay, then I have to reevaluate this and see what I think it's worth.
Yeah, because this what he's saying, stock price and company valuation are not correlated all the time.
Correct.
More times than not, they're not correlated at all.
They're either going to be overvalued or undervalued at any given time. So the next question you have to ask yourself as an investor is, why do we want to find undervalued stocks? Well, guys, Warren Buffett's analogy is this. When a bridge builder is building a bridge and they want it to hold 10,000 pounds, do they build it to hold exactly 10,000 pounds? No. They build it to hold 20,000 or more pounds. Why? Margin of safety. Every time you get in your car, you do a very simple thing. You put that seatbelt on. It takes 2 seconds. You'll probably never, ever need it, but it's that margin of safety. In case you do need it, you're going to be happy you had that. Yeah. So what is margin of safety? Margin of safety is you find a stock that you think is worth 100, hypothetically, and you're buying it for 70 or lower, whatever the price is, much lower than the price you think it's worth. Why? Because you don't know the future. And when you don't know the future, there are things that are going to happen that you didn't account for. That's why you have margin of safety. Look at Rivian yesterday. Rivian is a company everybody was hyping. It's great. And I like the truck. But what did they announce yesterday? We are recalling 100% of the vehicles that are out there in the market. That's why you have margin of safety, because those things will happen. You have to account for the things that you don't know that you don't know. And that's why we have margin of safety. It doesn't mean you're always going to be right. You're still going to be wrong sometimes. But the more margin of safety you have, the more likely you are to do well in the stock market.
Yeah.
In any investment, right, Mo?
Yeah. A company that we both own right now is Intel. So Intel is, we started buying this thing, what do you say, Paul? $40 somewhere in there?
I was high 40s, yeah.
Okay, so let's call it $40. We thought that this thing was worth somewhere in the 75 to 80 range. We weren't buying at 75 or 80. We were buying somewhere in the 40s, and now it's 26 or 24 or something. This right here was margin of safety. We didn't want to pay what we thought the value was. We wanted to pay nearly half of what the value was. And because we're down so much right now, it's still not bad. We still think it's worth in the $75, $80 range.
But it will take longer to get there.
Correct.
And so the question is, are we willing to withstand that?
Correct.
And that's the hard part about investing, right?
It is hard. I mean, this is hard. It's hard to go with that much of a loss.
Yep.
35, 40%, whatever it is.
So you might be like, okay, this makes sense. So how do I find these undervalued stocks? Well, there are a few major ways. One of which is look at 52-week lows. That's a great place to start. Yep. Just because a company is hitting its 52-week low, though, does not mean that it's undervalued. For example, look at a company like Costco. Costco's 52-week low is 406. It's currently at 460, but 406. We just did a video on Costco where I have my value significantly lower than 406. So let's say Costco went to 350 tomorrow. That would be a 52-week low. Guess what? I evaluated. It's still not there yet, right?
This is a 52-week low. NVIDIA.
Oh, NVIDIA.
$114 a share. Look at their current 5-year PE. 56, 5-year price to free cash flow is 58. This thing probably needs to fall in half for us to start getting interested in purchasing the stock. So like he said, just because you're at a 52-week low, just because the price is low, doesn't mean that it's a go buy right away.
Correct. So that's one way. Two, in our software, we have our 8-pillar search tool. Very, very simple. You can pick which pillars you want. And if you, let's say you say, hey, listen, my goal is just to find good companies. I don't care about value. I will determine the price I want to pay and add it to my watch list. I'm going to select everything but the valuation metrics of PE and price of free cash flow. And it's going to list all the companies for me. And I can go to each one that I want to do and evaluate them, run my stock analyzer tool, see where the analyst estimates are, use that to help me. And then when I determine a price, add it to my watch list. So if you look at my watch list, guys, I have 93 stocks on my watch list. This means that when any one of those stocks hits the price I determined on the low side, and that price is not necessarily a buy price. It might be, Paul, it's getting close. Start doing more research. I'm going to get an email and I'm going to get a notification on my phone and the app right here telling me the stock hit your price. Go do what you need to do. For some of you, you might sit there and say, hey, I'm going to add it to my watch list as a price to buy. I use it as a price to go do more research because it's getting pretty close. So for example, American Express, my target price is 125. It's getting pretty close. But I believe my buy price is about 110 or 100. I don't remember exactly. The point is, I'm glad I don't remember. It allows me to go evaluate the company again without having my previous bias of price and value in there. Right, Mo?
Yep, exactly.
So, like, what's a stock that you have, Mo, that you want to...
MasterCard. I have my price set right now at $200. It's at $287. So it's still a ways off. I don't want to pay $200. I'm probably looking somewhere in the $175, $150 area. But as soon as it hits $200, that's going to give me some time to go and research it and some time to sell some options on it and generate some income until that $150, $170 area.
Yep. So guys, buying stocks is tough. And I used to be exactly in your shoes. 27 years ago, I followed hype. I bought what my friends told me to buy. My biggest ever loss was 100% loss in Global Crossing because my sister's boyfriend's dad said, Paul, this company is the future. And it was the CEO was the fastest billionaire ever at that time. He did it in 11 months. And I bought it and it went to zero. And I'm not blaming him. I still made the decision. But the point is, once that happened, I realized, okay, there's got to be a better way. Yeah. And I started reading and I read about, I'd already known about Warren Buffett, but I started reading more about his process. I was like, wait a second, this makes sense. Because I remember when I was a kid, my parents would always buy things based on the discount. And I'd always say, but what if it's not really worth that and we're just buying in a discount? I didn't realize back then that that was me being a value investor.
Right.
Just because something's discounted doesn't mean it is a good deal. It just means it's discounted. It could just be very overpriced and that's fine. So how many stocks should you own? It all depends on the person.
Inevitable question. Yep.
What was that?
It's the inevitable question that everybody wants to know.
Warren Buffett has said diversification is for people who don't know what they're doing. More power to them. But I want you to remember, there's been Warren Buffett who beat the market with 10 stocks. There's Peter Lynch who beat the market owning hundreds of stocks and everything in between. What you have to do is what's comfortable for you.
Yep.
For what's comfortable for Mo and I believe, is 30 or 40 stocks.
Correct.
I'm not willing to do the minute details of owning 10 stocks and knowing them inside and out, and I would bet my life on them. No chance. What I want to do is I want to get down to the 50-foot level versus the average investors at the 10,000-foot level. But I'm not willing to go down to 1 or 2 feet like our friend Gary does, like Warren Buffett probably does. To me, it's more important to find a bunch of companies that I know and understand because they're so big, and that alone is going to make my returns lower. But I'm okay with that because I just want to avoid the big misses. I don't want to have the stocks that fall 80, 90, 100%. That's my big goal. And that has been proven over time that if you avoid the big losses, the big permanent capital losses of 80, 90, 100%, you will probably do well in investing.
Yep, exactly right.
So for me, 30 or 40 stocks makes sense. For you, it might be 10. For you, it might be 100. But my suggestion is if it's 100, probably just do an SPY ETF.
Yeah, at that point, you're generating your own ETF. Do an ETF that just works.
Yeah, and might as well match the market. Yep. And there's other things you can learn from our channel, like selling covered calls and selling puts to generate extra income to make above and beyond the market return. Okay, now finally, you found your stock, you love it. How do you value the stock? At what price you want to pay? Okay, so what we're going to do is we're going to pick up an example company. Because we already talked about Microsoft, let's pull up Microsoft. Microsoft is a behemoth of a company. It's huge. It's in our lives. Everybody uses it.
It's incredible.
Here's the 8 pillars on Microsoft. Mo, why don't you walk them through a little bit?
Yeah, so right now, when we look at our 8 pillars, these are just 8 metrics that we personally like to look at. These 2, we love to see in red because the other ones, the other 6 green checks, those tell us this is a good financially stable company. We don't have to worry about that when we go do our research. We don't have to say, oh my God, is this company going to generate cash flow? Or are they going to be okay in the future? What we do see, 5-year PE is really high, over 22.5. 5-year price to free cash flow is high. Those are just 2 value metrics. They say the stock is a little bit frothy right now. It's overpriced. Now we can go to Stock Analyzer and say, what do we pay for this? We don't want to pay $226. Maybe we want to pay $175.
Oh, wow, it's $226 already.
$226, isn't that crazy?
Oh my gosh, it was $350 as its high.
High of $350.
And guys, by the way, you could be okay paying 36 and 36 times, but you better have the growth to justify it.
Correct. And this company is $1.7 trillion.
Yeah, it's going to be hard to grow a $1.7 trillion company who does $200 billion in revenue, right? If it was $2 billion in revenue that could grow to $20 billion in the next 3 or 4 or 5 years, yeah, pay that multiple all day 100%. Because you can get there. But the question is, when it comes to paying a high multiple, do you have the growth potential? You have the moat here. You have the high ROIC, but do you have the growth potential for it that justifies it? So let's go look at the analyst estimates. Now, remember, guys, on our software, we have analyst estimates going out 5 years for EPS, earnings per share, and revenue. if you've heard me before, I do not like analysts buy, sell, neutral ratings. I think they're all garbage. And sometimes the analyst estimates are a little flaky on some weird companies that are very obscure. However, for bigger companies, I think I'm going to rely on them on the high side because I still think they want to be more aggressive on the high side for EPS and revenue. But it's a good way to start. So for revenue growth down here, boy, going out 6 years, they still have double-digit growth levels here.
I'm shocked when I saw that.
Okay. In terms of EPS, they have even higher.
Double.
I mean, this is incredible. So
Double from now.
they're talking about doubling their EPS in the next 5-6 years. So let's go use this as part of our stock analyzer tool. So we created the stock analyzer tool as a way of creating a model to tell us what we should pay for our stock today, because every investment is the present value of all future cash flow. We had an Excel sheet a year and a half ago. You can go back to our original videos and see that. And we'd literally get comments below, how do I get that Excel sheet? So we said, you know what? Let's just create the software. So we did that. This is the most popular part of our website. I literally will get screenshots in our community from people saying, Paul, check out my assumptions about this company. And I'll say, oh, what about this? What about that? Yesterday, somebody sent me Southwest Airlines, and their low assumptions on revenue growth was 3%. I go, whoa, I think that's insanely low.
Yeah.
So even me, a conservative guy, I said, listen, 3% is crazy. Maybe it was 4, I don't remember, but I was like, listen, I think that's too low. Yep. So we had a discussion about that.
Yeah.
So first thing I'm gonna do is I can pick 1 to 20 year analysis. I always standard do 10. It starts that way automatically. Now next, we had the analyst estimates for revenue growth in double digits, but this is going out 10 years and not 6 years.
Right.
So I want to alter this just a little bit. Mo, give me your low, middle, and high.
I put in 6, 8, and 12.
6, 8, and 12.
Yeah.
So you jumped up from the middle to the high, a big number.
Yeah. So the reason I went to the high is because the analyst said it was going to be 15 in 6 years. So I was like, okay, I'll give it 12. Let's see what the high side does.
Okay. So profit margin now, Mo. What we've seen here is profit margin has increased.
Yeah.
So in the last 10 years, it did 28%. Last 5 was 31. And the big reason I think was their AWS version, their cloud computing has a very, very high margin.
Yeah. So I put in 29, 31, and 33.
Okay. And the other thing is also not the only reason is they have a subscription-based business for Office 365.
That's true.
So that's a higher margin, recurring revenue. Okay. Free cash flow margin.
I put in the same numbers.
I agree. Now PE and price of free cash flow.
I went with 12, 14, and 16.
So why'd you do 12, 14, and 16?
You know, I just look at it as $1.7 trillion company. Is there a lot of growth coming in? But at the same point, I go back and forth because they do have a great moat.
Yeah.
So do I give them a little bit higher? So I kind of just settled there with 12, 14, and 16.
Okay.
If you said I think that's low, I would be like, okay, I think it's low.
I think 12 is too low for this company.
I do too.
Why don't we do this? Why don't we do 13, 14 and a half, and 16?
Okay.
Kind of split the difference a little bit. Okay. Now, desired annual return. Guys, if you invest in a long-term ETF that follows the S&P, you're going to get 9 or 10%. So for your desired return to buy an individual company and to have margin of safety, you should pick a number higher than that. Okay. And the higher the assumptions, the more margin of safety you need because you're less likely to hit the assumption. So you want to have a higher margin of safety. So Mo, tell me what you want for low, middle, and high desired return for Microsoft.
I think 12.5, 13.5, and 14.5 is fine.
I think I would agree with you on that one. So what Mo is saying is, on these high assumptions, it's less likely to happen. So I want a 14.5% return on that. Middle assumptions, 13.5, low assumptions, 12.5%. We hit the analyze button. Now, below, 6 numbers going to pop up. 3 values based on a multiple of earnings and 3 values based on a multiple of free cash flow. If it's all green, it does not mean you go out there and buy everything. What it means is verify these numbers are accurate. Okay. How do you do that? Go read on the internet, bull and bear cases of the company. Go do your own research. Read the 10K, which you can find on our metrics page on the very bottom left in annual reports. It goes right to the SEC website. But the easiest way to do it, and the reason we created this community, join the community. There are thousands of people in here that are like-minded value investors, people who look at an investment at a stock as buying a piece of a business. And they're all doing research. And it's so much easier to research with a group of people than by yourself. Value investing alone is a lonely road. We created, and then when I started in value investing, it was just me, literally just me. And I second guessed things. I'm like, wait, is this right? But then when you started to talk to other value investors and realize we're all like-minded, it gave me some ease and made me go, okay, this is good. This community is useful because people in there are talking. You can go in there, type in Microsoft. It'll take you right to the chat that's talking about Microsoft, and you can engage people. Ask them what their assumptions were, why they were there. And I guarantee with thousands of people in there, there are going to be bull and bear cases for both. Heck, there's people in here who believe in Tesla and crypto at this time. And obviously I do not. Yeah. But they sit there and say, no, Paul, you're wrong because of this. Great. That's a different way of looking at it. But for us, the reason we created this amazing community is we wanted this. But guys, the best part is when you join this community for less than $1 a day, you get everything that you've seen, including the retirement calculator, the stock analyzer tool, and let me show you everything else you get. So for this, $1 a day, you get the mobile app, you get 8 pillars, 30 years of financial data, the stock analyzer tool, which we just did. Every day, Mo and I give exclusive content just for the subscribers of our software. You get access to Mo and I, real estate calculator, stock screeners, retirement calculator, and this EM community chat that I'm talking about. And look, guys, $1 a day versus our competition, and look how much more you get. But guys, the value of a proper mindset, not just feeling good inside, but also in terms of the financial benefit you're going to have in the future. If I asked you on the street to give me $1 today, you'd give it to me every single day. You wouldn't care. This is $1 a day. It gives you all this stuff, including changing your financial mindset and future. This is a no-brainer. So go to everythingmoney.com and sign up right now. So back to Microsoft. We hit the analyze button.
Before you show it, I just want to point out,
okay,
guys, this is at a 52-week low right now. Okay, so whatever this spits out, this is going back to what we said at the beginning of the video. Just because stocks are at a 52-week low and cheaper than they were, doesn't mean go buy it right now.
All right, analyze button. Okay, so we have a low price of 110, a high price of 190, mid price of 150. It's on my watch list at 170, which means at 170, I'm going to start looking at it and doing more research. So guys, again, go to everythingmoney.com. This is a no-brainer. It'll be the best decision you make today. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?